I'm George Sanford. I'm Senior Specialist Advisor at Vibe Finance. So we're an award-winning specialist finance brokerage. We work solely with investors and developers, covering all aspects of investment property finance. So whether that's HMOs, we cover bridging development. We also cover commercial properties, buy-to-let, holiday lets, multi-unit blocks, all those kind of weird and wonderful things. So yeah, sit across that whole specialist sector. And the last month or so has been a particularly interesting one, keeping us busy. So if I dive straight into the graph firstly, and then I'll kind of go into a bit more detail around each point. What you're seeing here is a graph. I think it goes back to the end of 2024, actually. But this shows the SONIA swap rates. Now, this is probably your best indication of where mortgage rates go. A lot of people look at bank base rate, a little bit of an outdated way to look at it, to be honest. SONIA swap rates is the thing you want to be following if you want to kind of stay on top of that. And the website, as Rich said, is publicly available, this information. There's a brilliant website called Chatham Financial that I'd highly recommend anyone that wants to follow this stuff or is a bit of a mortgage nerd like me. Log in and you can see this data, and it's updated on a daily basis. So what you'll see there kind of back end of 2024 is obviously that kind of higher end swap rate stuff we had coming out of there. And then over the kind of following 18 months or so, you can see that steady decline until that first arrow at the bottom there, which is, I think there's 27th of Feb is the actual data point, but that's kind of obviously just at the end of February, just before this kind of war with Iran, Middle East situation really kicked off. So the first time we saw that really hit the mortgage market was kind of the week commencing the 9th of March. So that's when we started seeing lender emails coming through saying pricing's increasing, rates are going up, withdrawal pricing. Now, as I say, those that follow SONIA swap rates would have seen this spike, and that should kind of not ring alarm bells necessarily, but it should give you a bit of a heads up that, right, okay, things are going to be changing and probably changing fairly rapidly. I mean, you can see on that graph how much of a spike that is rather than like a gradual increase or gradual decrease compared to the previous 18 months before it. So in the first 2 weeks, so between that arrow at the bottom there and the arrow at the top pointing down, that's about a 2-week period there. So from the kind of 9th of March towards the end of March, that's where we saw loads of lenders across the whole market, buy-to-let, HMOs, commercial, across the whole space, doing one of two things. There was lenders that were increasing pricing. So they stayed in the market. They still had a product available, but they had to put the pricing up on that. And there were lenders that were withdrawing from the market completely for a time. So they were looking at this spike going, right, okay, we don't really know where to price ourselves. We're going to take back certainly all of our fixed rate pricing. They might have kept some tracker or variable products in. But actually we're going to step back completely and just not accept any fixed rate business for that time. So one of the key things to note when this kind of thing happens is that, as brokers, we get advance notice of this. So the lenders will send out an email, right, okay, rates are being withdrawn at 5 p.m. today or whatever it may be. Some lenders won't give us any notice. Sometimes we'll just get an email saying products are withdrawn or products are now higher. So really important to be kind of staying on top of these things or working with a broker that is definitely. Those that were increasing the pricing rather than withdrawing pricing faced a really difficult job. So you'll see in that graph, there's kind of two distinct spikes. You've got this first little spike and then a tiny little drop and then another spike. So what they were battling with is obviously they still want to remain competitive in a market. Don't get me wrong. Lenders need to lend money to make money. There's no lender out there that doesn't want to lend money as much as their underwriting process might make you believe it. They all need to be lending money. So their pricing is really important for them. So they wanted to stay competitive, but obviously trying to stay on top of this volatile swap rate market meant that we were seeing the same lender maybe reprice 3, maybe even 4 times within the same week. We had lenders literally reprice on a Monday night, and then we get another email late Tuesday saying they were going to go up again on the Wednesday. Now that's the kind of speed these things can move at, and shows the kind of little notice that they're giving. So that's really important to note. Those that withdrew their fixed rate pricing took probably what is a safer reputational option, i.e. they weren't kind of looking quite as bad, but it did mean they were lending probably next to no money during that period, which is obviously not great for their kind of back book. So there's kind of arguments to and against both situations. Thankfully, as of today, pretty much, I think, as far as I'm aware, every lender is back in with their fixed rate pricing. So if you move on to the kind of last part of the graph there, you'll see that little decline. So that's really the last week and a half or so, kind of from the start of last week. So it's kind of steadied out a little bit. As you can see, it's kind of dropping down slightly again. So this has kind of encouraged the lenders to come back in. And if anything shows that the market is quite resilient, it's quite keen to recover by the macroeconomic things allowing that it will do that. Just to put some numbers around this for you guys, the top peak you can see there where that kind of top arrow is, that's a SONIA swap rate of about 4.5%, which isn't, if you look really long term, isn't abnormal. Anywhere between kind of 3.5 and 4.5 is kind of historically average. But obviously that significant spike is what causes the kind of panic as such. Now, Rich obviously talks a lot about over leverage and things like that. So who benefits from this situation? Well, nobody really benefits, but who's best protected are those that are stressing their deals in the right way. So not over leveraging, making sure that actually, okay, great, rates are 4.5% today, but what happens if they turn into 6.5% when I need to refinance? So making sure your deals are protected by that. And also those that are, we call it document ready. So if you were looking to refinance or purchase a HMO at the start of March, you would have been directly impacted by this spike in rates. There's not much you could have done about that. However, being document ready, and by that I mean having ID, pay slips, proof of income, proof of address, bank statements, ready to go, labeled, neatly packaged documents, that would have meant that as a broker, we've been able to submit your case more or less immediately, locking in the rates as we quote them, rather than if I quote you something on a Monday, that rate could have been 0.5% higher come Wednesday. When you've tried to pull those documents together. So again, just to finish up and round up, so just to put some numbers around this for you guys. So kind of, if we looked at the start of the year, so January, February time, HMO rates kind of sitting circa 5.5%, depending on how you want to play it with lender fees for kind of a fairly bog standard case. That's kind of spiked up a little bit. You're probably looking at kind of 5.5 to 6 for your bog standard stuff now. The caveat to that is you've still got the specialist side of the market. So your larger HMOs, your property situated above or very nearby commercial, supported living, maybe complex client profiles, adverse credit, expats, foreign nationals. So you guys are going to be sitting probably kind of 6.5 to 7 at the moment. You'd have been 6.5 before. The specialist side of it, I should say actually as well, probably impacted slightly less, kind of trickles through. So you'll see the high street get hit first, the more bog standard lenders next, and then the specialist lenders go last. So the specialist lenders have had a lesser impact because they build in higher margins, because they take in higher risk profiles. They can kind of swallow a little bit of it. But as I say, the market's heading in the right direction now. So this is as of this afternoon, this graph. So it's heading in the right direction. I think the market looks fairly keen to recover. We've started seeing our first set of lenders reducing pricing, taking it kind of back towards where we were previously, which is obviously great. So yeah, I think that's kind of an overall summary of where we are and what's happened. And hopefully what will continue to happen is that kind of dropping down into that kind of 3.5 to 4% range and a bit more stability.